For those of you not familiar with Millbrook, we're a specialist property credit fund managed based out of Melbourne, and we've been around for some 17 years now. Unsurprisingly, today's topic does revolve around property credit, and I'm going to look at some of the key themes and also look at the role it can play in investment portfolios, amongst other things. And we had some great questions in the previous events in Melbourne, Brisbane, Adelaide and Perth, so certainly welcome those at the end. But I'll kick off by giving a bit of an overview of the private credit market as we see it at Millbrook, and look at the role the asset class can play in investment portfolios. Then I'll start to specifically talk about property credit and look at the key characteristics of the asset class, so benefits, risks, key investment guidelines and liquidity guidelines that are typically followed. Then I'll get a little bit self-indulgent and talk about some of the investment options we have at Millbrook. And then finally I'll finish by giving a property outlook and some broader insights into the property credit sector for 2025 as we see it at Millbrook. So kicking off with the private credit market overview. Now, private credit is an asset class that's been up in lights in recent times. It's been getting a lot of attention, both good and bad, but it's a very broad term and it's a very broad investment universe. There's all sorts of different loans that fall under the private credit umbrella. They often get bundled all into one, but no one loan is the same. But predominantly, the market comprises of four main areas. You've got corporate SME loans, you've got commercial real estate loans, you have consumer loans, and you've got residential mortgages. So corporate SME loans is typically direct lending to corporate or business entities, usually to help them fund their business expansion or working capital requirements, not always secured by physical property as security. Then you've got commercial real estate loans, which is lending to corporate and business entities, but always backed by some form of real property security. And it may be for development, it may be for investment, it may be residual stock, but it's always has some sort of property backing the loan. Then we have consumer loans. Here you're probably thinking lower value, higher volume type loans, so things like asset finance and personal loans. And then finally you've got residential mortgages, which is fairly self-explanatory. Now, historically, banks have provided the majority of funding for all these different sectors, but that has steadily reduced since the GFC, and the void has absolutely been filled by non-banks and private lenders since in that time. At the moment, the market share of non-banks and private lenders sits around 14% of the overall corporate lending market, so there's been some significant growth in recent times, and the next few slides will hopefully help you visualise that. And some recent analysis even suggested that the private debt market could surpass the Australian corporate bond market in size in the next 5 years. So that again highlights that I think this sector is certainly here to stay, and there's still plenty of growth opportunity. But ultimately, I think, and many others believe that there has been a structural shift that's gone on in the Australian lending environment in recent times, and that's where banks have permanently retreated from certain lending sectors, and that void has been permanently filled by non-banks and private lenders. This next slide just highlights the growth that has gone on in the private credit market in Australia. So you can see from 2015 through to 2024, really, really strong growth. 2015 it was around 40 billion. By 2020 it was up over 100 billion. 2023 nearly 200 billion, and last year did tick over that $200 billion mark and sits around 205 billion at the moment. You can see from 2015 to 2020 there was significant growth. A lot of that came down to the impacts of the Basel III regulations. This is where the banks really started to fully implement the new capital requirements that were imposed on them. And that meant that they pulled back from certain sectors, and obviously that void filled by non-banks. So that's why you see that really strong growth in that time, from that time period. The next slide specifically looks at commercial real estate debt and the total non-bank commercial real estate market share. And again, you can see exponential growth from 2020 through to 2024. About 7% market share in 2020, and by last year was sitting around 16 to 17%. So even more growth in this sector. The right-hand image on this slide helps explain why some of this growth has happened, and it looks at typical bank covenant examples for commercial loans. Now, I don't want to bore you with all the different covenants that can be imposed on commercial loans, but I think this just helps illustrate the more onerous conditions that are now imposed on borrowers, and that lack of flexibility has been driving them to non-banks. So if you look at the first row, you've got a typical maximum LVR that a bank would offer. So pre-GFC, they typically offer around 75%. Between 2009 to 2015, that did reduce to 65%, and post-GFC, the maximum LVR that banks would offer on a commercial loan was down to 55%. So that, far less palatable for borrowers, a lot less flexibility, and certainly more onerous. And then if we look at the minimum pre-sales row, this obviously only applies to commercial construction and development projects. But typically, pre-GFC, the banks were happy if the developer and the borrower had got about 50 to 80% pre-sales before they'd provide funding. Between 2009 to 2015, that reduced to 80 to 100%, or increased to 80 to 100%. And by post-2015, typically they were looking for 100% in pre-sales before they would provide or approve the funding. So that's not very palatable to a borrower or developer, and that is why you've seen that growth in the non-bank market share in this space. But Australia's a bit of a laggard compared to some of our global counterparts. So if you think about the States, when it comes to commercial real estate lending, it's about an even split between banks and non-banks. And in the UK, non-banks have about a 25% market share. I'm not sure we'll ever get to the 50-50 mark that the US has, given the fragmented nature of their banking environment, but I certainly think there's still strong room for growth here in Australia. Moving on, this is just a very simple risk-return graph, just to show you where we think private credit sits on the risk-return curve, and we're of the view that it sits somewhere between bonds and high-yield credit. But as I mentioned before, no one loan is the same in the private credit universe, so ultimately it will depend on the type of loan that you're investing in, and that will determine where you sit on the curve. So if you're investing in a loan that is backed by a first mortgage with a conservative loan-to-value ratio, I'd argue you're down towards the bond end. But if you're investing in maybe mezzanine finance or a corporate loan that's not backed by physical security, I'd suggest you're up towards the high-yield end of the curve. This next slide just is looking at the role the asset class can play in investment portfolios. And I really love the slide. It comes from Revolution Asset Management. And it uses the analogy of a role on a soccer team as compared to a role in an investment portfolio. I think it's just a good way to think about how private credit can fit in an investment portfolio. So if we look at the top, we've got the role in investment portfolio, we've got the investor or allocator. So all of us in the room today. And then our role in the soccer team is seen as the coach or the manager. So fairly self-explanatory, there to make all the decisions for the team and also for the portfolio. If we then look at listed equities, venture capital and private equity, their role in the soccer team is seen as the strikers. So they're to get forward and kick all the goals. And when you think about those types of assets in your portfolio, it's probably what you want them to do, generate you really strong income and capital growth returns over the investment cycle. And then we've got private credit. So its role in the soccer team is seen as the attacking defender or wing back. So they're to provide defensive cover, but also get forward and help attack and kick the odd goal. And that's exactly what private credit can do in a portfolio. It's got those defensive characteristics of capital stability and low volatility, but you also get that enhanced yield above what you're going to get, obviously, from cash and TDs and other fixed income investments. So if you're not using private credit in your investment portfolios at the moment, I think this is a good way just to think about how it potentially could fit in there. And we're of the view that property credit and private credit sits in the fixed income sort of bucket of your portfolio. It suits investors looking for income. There's no capital growth opportunity with the asset class, but we also argue it's a little bit more of an active way of investing in what can be a fairly passive asset class when you're thinking about cash and term deposits, at call investments and things like that. And not to labour on the point, but I think this performance comparison slide again just helps illustrate some of those key characteristics of the asset class and helps emphasise the role it can play. So here the property credit example we've used is our Millbrook Credit Fund Diversified. That's that thick light blue line. And as you can see, over this time frame, very little volatility, very stable return generated, but a return that was above and beyond what you're getting with above the cash rate and obviously government bonds. But then again, without the volatility that you experience with the ASX and the Australia MSCI index. Just moving on now to specifically talk about some of the key characteristics of property credit as an asset class, and the real distinction with property credit is that it is backed by some form of real property security. So this image here just depicts the typical capital stack of an investment. So senior debt first mortgage, that sits at the top, so it has the highest priority and therefore the lowest risk. Then we go down to subordinated debt, then preferred equity, and then common equity, which obviously has the lowest priority and therefore the highest risk. So, as I said, all property credit loans are backed by some form of real property security, and typically it's a registered first mortgage. So that's critically important because you as the investor, or we as the manager, we're sitting at the top of the capital stack. So if something does go wrong in the worst case scenario, we're first in line to recoup capital. And there are certainly very strong creditor protections in Australia for first mortgage holders. You've got strong rights to enforce. This next slide just compares property credit versus direct corporate lending, and direct corporate lending is a very big part of the private credit universe, and sometimes these two just get bundled all into one. But as I mentioned, no one loan is the same, so I thought it was just worth highlighting a couple of the differences here. With property credit, the loan purpose will vary, but all loans, as I said, are backed by real property. It's direct lending to corporate and business entities, and it's typically fully secured by that first registered mortgage, which is critical, plus general security agreements over the company's assets and director guarantees. Again, with direct corporate lending, the loan purpose will vary here as well, but it typically includes funding business expansion or business requirements, or it might be funding a company's working capital requirements. Again, it's direct lending to established businesses or corporate entities. And when it comes to security, it's always going to be secured by a charge over the company's assets, but the loans are not often backed by real property. So in many instances, they're what I would distinguish as security light. So that's the big difference between the two. Property credit's got that, always has that backing of real property, whereas direct corporate lending doesn't always. Two ways to invest in property credit. You've got the pooled fund approach, or you've got a contributory mortgage scheme approach. So with a pooled fund, that's where investors derive income from a diverse range of different loans, or a diverse pool of loans. Investor capital risk is mitigated because it's spread across a variety of different first mortgages with varying loan-to-value ratios, security type, security location, and the like. And it is more liquid because loans are repaid regularly, so you've got loans rolling on and off regularly to help with that liquidity. Now, with a contributory mortgage scheme, that is where investors specify which mortgage or which loan to invest in, and it's typically secured by a single property or single asset. So therefore, the risk and return is very much more dependent on the quality of the borrower and the loan-to-value ratio, so your risk is very concentrated, but you do typically get rewarded with a higher return for that potentially increased risk. This approach is typically less liquid because you can only withdraw your funds when the mortgage or the loan matures. Moving on to the key benefits and the key risks of property credit, and here I'm really focusing on first mortgage and pooled funds, although a lot of the benefits and the risks are universal across property credit as an asset class. But the number one benefit is certainly the attractive yields and reliable income that you can get. Diversification is another big benefit, and I think that performance comparison slide that I showed earlier highlighted the fact that it is largely uncorrelated to the equity market and other asset classes. You've got low volatility, you've got capital stability, so really good benefits there. Weighted average shorter loan durations in a pooled fund can help provide for greater liquidity because loans are rolling on off regularly. And in recent times, it has been a good protection against inflation. So most property credit funds have been writing loans on variable rate terms. So as the RBA cash rate was going up over the last 2 years, borrower rates were ticking up, and so too were investor returns. So you got a bit of a hedge against inflation there, which was good. In terms of risks, well, certainly it's not an at-call cash investment or a term deposit, so it's less liquid than that. But a pooled fund isn't probably as illiquid as many might think. There certainly are liquidity restrictions imposed, but returns do benefit from that illiquidity premium. Because these loans are backed by real property, any sort of property downturn, particularly a major property downturn, could be a risk or big risk. But most managers can mitigate those risks with things like conservative loan-to-value ratios and diversification in the loan book. On that, a lack of transparency or a lack of diversification in the loan book is certainly a risk. So if the loan book is too skewed to one particular type of loan or one particular jurisdiction, well, then that's certainly something to be mindful of. And manager selection, always important to select a good manager with any investment into a fund. But I think critical at this point in time, there's a lot of new funds coming out in this space. So you just want to make sure that you you're selecting a manager with the requisite experience. And on that, what to look for in a property credit manager, well, it goes without saying, management experience and skill is important, but I think risk management capability is the number one thing to be looking for here. As I mentioned before, there's no capital growth opportunity here, so the alpha or the outperformance is really derived from loss avoidance. So you really want the credit team to have really strong experience. You want a bit of grey hair factor in the team. You want them to have been through a number of investment and credit cycles. Inevitably, when you're lending money, whether at a big bank or a small private lender, things can go wrong. So you want the credit team to have navigated through those different scenarios and had experience in that, and you want them to be battle tested. So if you're looking at a fund and they've got that type of experience, well, I think that's a tick, but maybe if they don't, well, that's something to be mindful of. Just going to move on to some key guidelines that most property credit managers will reference. Here I've just utilised our Millbrook diversified guidelines, but as I said, most of these will be common across many property credit managers. We have a preference for shorter loan duration, so we only do loans up to a maximum of 24 months, and I'll talk in more detail about the reasons why we do that on the next slide. We minimise construction loans and have a preference for residential property as security that backs our loans. And the main reason there is that residential properties, the demand for them in the major metro cities, is strong. The values are well defined, and in a worst case scenario, it's much easier to sell a residential asset than it is a half-complete commercial project or development project. Geographical diversification is certainly important, but not going to diversify the loan book just for the sake of geographical diversification. Each loan still needs to meet the key criteria. We don't do any consumer or regulated mortgages, so loans that fall under the National Consumer Credit Protection Act. And those loans are typically home loans to your mum and dad's to buy a first home. So we're not involved in any of that type of lending. All our lending is to corporate and commercial entities, so it's considered unregulated. And the reason we don't do any of those regulated loans is for a number of reasons. One, those loans tend to be much longer terms, 25, 30, and you can even get a 40-year home loan now. They tend to have much higher LVRs, so upwards of 80% plus, and they typically are on lower borrower rates. So that in turn would mean, obviously a lower return to the investors. So that's the main reasons why we don't do any of those types of loans. Taking a conservative approach to LVRs, so we're targeting a weighted average between 50 and 60%. Don't lend against specialised assets, so things like aged care, childcare, NDIS or petrol stations. Now, it's not that we're against those asset classes, but it all comes down to the exit being potentially compromised. So if you think about an aged care centre or a childcare centre, it's very hard to repurpose that asset for anything other than what it's been utilised for. So in the worst case scenario, if you had one of those assets and something went wrong, if you had to sell it, there's a very limited buyer pool. So that's the main reason why we don't lend against those types of assets. And obviously most property credit managers will have liquidity guidelines to help with portfolio management, and I'll also talk in a little bit more detail about that as we go on. So with loan duration, I mentioned the fact we only do loans 6 through to 24 months with a weighted average around 13 months. So it means loans are rolling on and off regularly. So that helps manage and mitigate liquidity risk. It also helps minimise and mitigate vintage risk. Now, what do I mean by vintage risk? Not talking about potentially your wine going off in the cellar. It's all around the time elapsed since origination. So if you think about a 30-year home loan, if we originate that today, over that 30-year time frame, a lot of things could change in the borrower's circumstances, potentially for the good or potentially detrimental to the loan. But if we originate a loan today and it's a 12-month loan term, and assuming we can originate and underwrite that appropriately, we've got a greater degree of confidence that not a lot is going to change over that 12-month time period. So that helps us mitigate that vintage risk, and it means vintage risk is not building up in the portfolio. The other really big reason why I have a preference for shorter loan durations is it means you can pivot the loan book quickly. So we can go between fixed and variable rates depending on market outlook. So if you think about, if I look at an example in our fund, about 18 months, 2 years ago, our entire loan book was fixed. By the end of 2024, 95% of the book was variable. But at the start of this year, given the RBA cash rate outlook and the recent cut, we've started to do a few more fixed rate loans. So it's really useful. Having those shorter loan durations means you can pivot quickly. Also means you can pivot between different security asset types depending on the market outlook. So an example there from our business is that we started to lend against, we did more lending against industrial assets last year because that asset class is performing strongly, and we're happy to provide debt against those. In terms of liquidity, most property credit managers, including Millbrook, typically like to hold a balance of around 5 to 10% in the portfolio, and have about 5% of cash available for liquidity each month. Because of the shorter loan durations, approximately 90% of our portfolio could be liquidated within 18 months. We're available on platforms as many other funds are, so we do offer access to capital monthly, albeit with a discretionary monthly cap. But ultimately what we're trying to achieve, and many others are, is a return of 3.5% above the cash rate, and we think that's a pretty good premium for the liquidity risk that you are taking. And just a further comment on liquidity, we often get asked when we're out and about liquidity and potential restrictions and things like that. And there are a number of property credit LICs now available on the market, and they're fantastic because they offer daily liquidity, they offer ease of access for investors to get access to this asset class. But these LICs then are exposed obviously to market volatility, and the NAV can be at a discount, and they certainly are more correlated to the equity market. So although certainly nothing wrong with them, and as I said, daily liquidity and ease of access is a great benefit, but you do start to lose some of the benefits of a direct property credit investment, which is that low volatility and uncorrelated nature to the equity market. And ultimately, how much liquidity do you need in a portfolio? Here I've just outlined a couple of the Future Fund and a couple of endowment funds in the States, and certainly not trying to suggest that these funds have the same investment profile or investment time horizon as a typical investor. But it just highlights, that the types of less liquid assets, or the amount of less liquid assets that they do invest in. So the Future Fund has about 30% in what I'd call less liquid assets. Harvard Endowment Fund, a well-known fund obviously in the States, is a real outlier. Only got about 14% in equities. So they've got an extremely long investment time horizon. And then the California Public Employees Fund, one of the biggest pension funds in the world, is a bit more like the Future Fund with about 30% in less liquid assets. Just going to pivot slightly to talk about some lending principles. Here, again, looking at the ones that our team follow, but these will be very common across most property credit funds. And I certainly don't want to bore you with a deep dive into credit analysis, but just thought worth highlighting some of the key principles that are typically followed when making a lending decision. Sponsor risk, obviously important, character and experience of the borrower. Alignment of net worth to debt is a big one. So if someone's taking out a loan or looking for a loan of say $10 million, but their net worth or net asset position is $500,000, we'd argue there's a misalignment there, and there's probably a bit of a red flag. Use of funds is important. Does it make sense? You'd be surprised how many loans our origination team get where the loan purpose or the use of funds just makes zero sense. Want to make sure the borrower has considered how they're going to repay the loan, and if there's key things that need to happen, is the timeline set and defined. When it comes to development funding, which is not a huge part of what we do, but we still certainly provide facilities for this. Builder risk is a big one. It always has been, but probably even more so at the moment. So the team will look at not only borrower financials, but also builder financials to make sure the builder is viable. Project obviously needs to be feasible, and has it been fully considered? Obviously, if there's market pre-sales, that indicates there's been some sort of market acceptance, so that's good. And when it comes to land projects, whatever they're planning to do with that loan, land, whether it's subdivisions or some sort of development, has that been fully considered? And exit is a really big one, particularly for shorter loan durations. That is how you're going to get repaid. So the exit needs to be clearly defined. Multiple exit sources is fantastic, but if the exit seems, or the proposed exit seems a little bit wishy-washy, well, again, that would be a bit of a red flag. We often get asked about what types of loans are in the portfolio, and these are a couple of loans that are in or one loan that is in our Millbrook Credit Fund, diversified, and one loan that we did not proceed with and did not put in the portfolio. On the left-hand side, we've got a loan that we did proceed with. This is a loan in Queensland, backed by a residential asset and a first mortgage. The loan-to-value ratio was 65%, so up at the upper end of what we would normally do, and the term was 12 months. So here, the borrower was obviously a corporate entity, but they had a pretty strong asset and liability position. They had pretty strong income that was able to be verified, and they had multiple exit sources. So what they were doing here, they were leveraging a residential asset they had in their pool of assets to go into another investment, and they had some other assets that they had on the market to sell. So it was a bit of a quasi-bridging type scenario. So that was a loan that we proceeded with and now sits in the portfolio. And on the right-hand side is a loan that we did not proceed with. Again, it was a residential asset, first mortgage, and this time in Berwick, so a well-established outer suburb of Melbourne. The proposed LVR was 50%, so pretty conservative, and the loan term again 12 months. Now on face value, that looks like a pretty solid transaction, relatively conservative metrics, but we didn't proceed with this one, and it was all came down to the exit being compromised. So the property in question had some environmental issues, and when the team were talking to local agents, they indicated that it was a relatively illiquid asset and a likely sale period of 12 to 18 months. So we don't go into loans thinking that they're going to go bad, but you've always got to take into consideration the worst case scenario. And if we did have to sell this type of asset, a 12 to 18 month time frame is far too long to recoup investor capital. So that's the reason that one was not proceeded with.
Moving on to our investment options. So I'm going to start with the Millbrook Credit Fund. So this is, as many of you know, is our retail offering issued under a product disclosure statement, and it only invests in first mortgages. Two ways to invest. You can go into our select loans, which is where you get to pick and choose which loan you want to invest in based on your own risk preferences, or you can go into our diversified option, which is our pooled first mortgage fund. With the select, at the moment, the returns are between sort of 8 and 9%, obviously depending on the type of loan. If you think down there towards 8%, it's going to be a conservative loan to value ratio backed probably by a residential asset, and up towards the 9% mark, you're probably looking at maybe a construction project. The term obviously is going to be based on the individual loan that you're investing in. When it comes to the diversified fund, at the moment we're returning 7.25% per annum, which is paid monthly. The minimum term is 12 months in this fund. And I'll touch on a little bit more detail on the next slide on the makeup of this portfolio and some of the key guidelines that we adhere to when managing that fund. So for this fund, we'd certainly have a preference for residential security as the backing or as the security for the loans. The main reasons are there is that residential values are better understood. We've got more confidence in those, and there's a lot of demand for assets across the metro cities of Australia for these types of assets. We put a limit on construction and vacant land in this portfolio, so at 20% respectively. There's a maximum allowable of 5% in any one borrower or any one loan in the fund. And we're targeting a weighted average LVR of 50 to 60% in the portfolio. And at the moment, we're hovering around 55%, so pretty good capital buffer there for investors. And at the moment, there's about 72 different loans in the portfolio, so pretty well diversified by loans as well. In terms of the portfolio mix, you can see there the security type has got that skew to residential property, and then we've got a nice mix of vacant land, commercial, construction, industrial and cash. And then security location, David's mentioned before, obviously we're a Melbourne-based fund manager and we've got an overweight to Melbourne and Victoria, but we'd certainly like to certainly increase our New South Wales and South East Queensland loan book. And obviously we've got that presence now in New South Wales to help with that. But we won't just geographically diversify the book just for the sake of it. Every lone's still got to meet the criteria based on our lending policy. To the income fund, so this is our wholesale offering, so only available to wholesale investors. And the big difference with the income fund is it invests in first and second mortgages. Again, two ways to invest. You can go into select loans where you get to pick and choose the loan that suits your risk preferences. And at the moment, on a first mortgage basis, you're probably looking at high 8s to high 9s in the income fund. And if you're looking at second mortgages, when we do those, you're probably looking at around 14 or 15% return there, but obviously with a very different risk profile. Then we have the Millbrook Income Fund Enhanced. That is our wholesale pooled option. And the last quarter's return was 9.72% per annum on an annualised basis, and that is also paid monthly. In terms of the enhanced and the portfolio profile, the full year return, so from April last year through to March this year, was 9.75% per annum. The weighted average LVR cannot exceed 70% in this fund, and it's currently at 63%. Maximum of 30% is allowed in second mortgages, but at the moment we're only at around 16%, and we'd probably like to keep it under 20% going forward. And it's spread across 38 different loans at the moment, so pretty well diversified, and no loan greater than 5% of the portfolio, and the fund can have no borrowings. When it comes to the portfolio mix, pretty happy with the security type mix. As you can see there, it's spread quite evenly across all those various sectors. And again, with the security location, certainly an overweight to Melbourne, but again, we're looking to do more in New South Wales and Brisbane there.
And now, just to finish up, with our view on the property market and also our view on the property credit sector specifically for 2025. So, in terms of the property market, we think it's been, or it has been, and is performing reasonably well, but not uniformly across Australia. So, when it comes to residential property, Brisbane, Adelaide, and Perth had really strong growth last year and continuing to perform relatively strongly. Sydney was a bit more subdued. And Melbourne actually experienced negative growth in 2024. It has picked up again. It's gone back into positive territory in 2025, but nonetheless, it certainly was the laggard across the country. And I could certainly have a rant about the Victorian State Government, but we'll be here all day in regards to what they've been doing with property taxes in particular. But nonetheless, valuations, particularly for residential properties in the metro cities, and particularly affluent areas, have been holding up pretty well. I've mentioned industrial property, and we certainly think it remains the best performing non-residential sector. The yields remain strong. They've come off the highs of 2024, but there's still a lack of industrial land in the metro cities, so there's still good demand for those types of assets. So we're still certainly happy to support loans backed by industrial properties. We're still cautious on any BEC and any subprime commercial office accommodation. There's still pretty high vacancies in some of the metro cities. There's a lot of fairly high incentives still being offered by landlords. And obviously there's still the work from home phenomenon going on. So we remain cautious. We don't have any office accommodation in our funds. Not to say that won't change though if the outlook becomes more positive. And finally, some market insights on the property credit sector. We are of the view that rates and returns have peaked in the sector. We think the expectation for investor returns is certainly going to pull back. And that's on the back not only of what's going on with the cash rate, but also there's been downward pressure on borrower rates with increased competition across the sector. But we still think investors are going to get rewarded with pretty good risk-adjusted returns when compared to other fixed income investments. I mentioned competition, and certainly quality loan inquiry did slow in 2024 on the back of that increased competition. Pleasingly, we have seen a bit more demand pick up in 2025. And I think if we get further rate cuts, that should instill a little bit more confidence into the property sector. It might mean that some developers or investors that have been holding back on doing a project or investing into something are more likely to go into a project as borrowing costs pull back. In terms of the overall sort of non-bank private lending space and market share, I've obviously showed some slides of the growth that has gone on. I think that's going to continue. Banks are still incredibly slow to act when it comes to approving loans with any type of complexity. So you're looking at 3, 4, 5, maybe even 6 months for an approval. But places like Millbrook and other property credit funds, can settle a loan within 2 weeks. So that speed to market is still, driving growth in this sector. Banks continue to avoid certain security types, continue to remain inflexible with certain things, and also lack a bit of capability now within their teams for anything more complex. But, to be fair, they are heavily regulated by APRA, and I've talked about that structural shift, and a lot of that is due to, the capital requirements that are imposed on our big banks. And if you think about a home loan versus a commercial loan, the banks have to allocate about 4 times the capital to a commercial loan as they do to a home loan. So that's why they focus on home loans. It's more profitable, it's easier, probably need less capability as well. And that's why, borrowers are looking to non-banks and private lenders in the first instance now. Ultimately, I think that's, it means there's going to be better borrowers utilising non-banks, and ultimately means better risk-adjusted returns for investors, which I think is obviously a good thing.